All right, let's jack in. You feel it too, don't you? The market, it just feels off. Like a flicker in the code, a ghost in the machine. And you're not imagining it. Right now, there are two completely different realities playing out. There's the one the suits want you to see, and then there's the one that data is practically screaming at you. Today, we're going to decode that glitch.
See, the architects of this whole system, the suits, they're playing chess. They're modeling these slow-moving pieces, things like interest rates and tariffs, way out to 2026. But here's the thing. The game has changed. The last crisis wasn't chess. It was a digital bank run that went down in hours, not months. So the real question is, can their old-world models even handle new-world speed?
Okay, time for the mandatory compliance shield. Look, I'm a space ape staring at glowing rectangles. I am not your financial advisor. This is just educational banter, a deep dive into the data. It is not a signal to ape into anything. You have to remember, the market is literally designed to eat the uninformed for lunch. So do your own research. Got it? Good.
All right, first, let's look at the world through their eyes, the official story. This is the blue pill reality, right? The polished, slick matrix that the establishment wants you to believe is fact. It's calm, it's orderly, and it's all built on a couple of key assumptions. So what are the suits actually watching? They're watching these big, slow-moving variables. Goldman Sachs, for example, is laser-focused on this, an 18% effective tariff rate. Now, that's a huge number, for sure, but to them, it's predictable. It's like a giant freighter on the horizon. They feel like they can just steer around it. It's all manageable. But what they're not modeling is the rogue wave that's forming right under their hull. And what's really interesting is the main catalyst in their story, the rocket fuel. It's all about AI. They're forecasting a jaw-dropping 175% plus growth in power demand just from data centers by 2030. This is the big multi-trillion-dollar story they're selling us. It's this huge generational growth opportunity that powers everything else. It's clean, it's compelling, and it keeps the whole machine humming along. In this quote, this just perfectly captures the vibe in the official matrix. When things get shaky, when volatility spikes, what do you hear? Oh, it's just a garden variety pullback. You know, nothing to see here, folks. Just stay calm, buy the dip. They tell you it's a feature, not a bug. The system is working exactly as intended. Or is it?
Because back in January 2021, the matrix flickered. A glitch popped up that was definitely not garden variety. No, this was an anomaly that suggested the fundamental code of the entire market was, broken.
Now, the timeline is history, but the data points are what's absolutely critical here. Short sellers lost $6 billion. Then, just like that, brokers turned off the buy button. But here's the most telling number of all. Reported short interest dropped from an impossible 114%, meaning more shares were shorted than actually existed, down to 39% in just a few days. This was not a pullback. This was a systemic stress test that shattered the machine.
So in the fallout, the apes found a countermove. It's called direct share registration, or DRS. Think of it this way. When you use a broker, you basically have an IOU for a share. But with DRS, you pull the actual share out of the casino and lock it in your own vault in your name. It's the difference between I own this and I hold this, and that distinction is critical.
And this is where we get the two competing narratives. The official story, the one you read in all the headlines, was that this was just some random, meme-fueled frenzy, an isolated thing. But the ape reality, which came from these deep dives on forums like Superstunk, says something totally different. The GameStop wasn't the disease. It was a symptom of a much deeper systemic flaw, a battle over the very idea of fair price discovery.
Now, for a while, you could just dismiss the ape reality as some kind of conspiracy theory, a one-off glitch. But then, in 2023, the exact same pattern showed up again, just with a different catalyst. And this time, academics were watching. They captured the data, and they proved the glitch is a repeatable, quantifiable phenomenon. It's not about memes anymore, it's about math.
This right here, this is the timeline of the Silicon Valley bank run. It looks pretty simple, but this is the moment the physics of the market changed forever. A bank run that used to take weeks of whispers and rumors now happened in a matter of hours, fueled by a brand new catalyst. And like I said, this time, the quants were watching. They measured the glitch.
And here is the proof. Researchers tracked all these regional banks during that crisis. And the result? The banks that were being talked about a lot on Twitter saw their stock prices fall way more than the ones that weren't. The conversation on social media literally became a quantifiable, toxic asset on their balance sheet.
So the key takeaway is this number, -6.6 percentage points. That is the quantifiable penalty for being talked about on social media during a crisis. It is a hard data point that proves sentiment is now a risk that high-frequency trading bots are scraping and pricing in faster than any human possibly can. It's a variable their old models simply cannot account for.
So if social media is the accelerant, what's the fuel? Right? Why is the system so incredibly vulnerable to these little flash fires? Well, the ape thesis points to a fundamental mechanic deep inside the market's plumbing. They call it the infinite liquidity gambit.
This quote from the superstunk thesis just frames the conflict perfectly. On one side, you have the market maker's absolute need for infinite liquidity. That's the ability to just create shares out of thin air to meet demand. And on the other side, you have the investor's right to fair price discovery, where the price is set by actual supply and demand. The thesis argues these two ideas are now in direct, violent opposition to each other.
So here's the breakdown. The ape thesis argues the system relies on this idea of infinite liquidity, and that it's created by things like naked short selling, selling shares you don't actually have. All of this is controlled by one central entity, the DTCC. So the countermove, the one thing that fights back, is DRS, pulling your real shares out of their system, which starves them of the supply they can use to play their games.
So, this brings us to the final verdict. We've got two completely different ways of reading the code. One version says the system is resilient, that it's adapting. The other says it's caught in a fatal loop. So which one is it? Is this a massive buying opportunity, or is it a trap? The bull case, which comes courtesy of the suits at Goldman Sachs, is that the system is just going to adapt. They point to things like resilient corporate credit metrics and say, look, the market is mid-cycle, it's not on the verge of collapse. The bear case, which comes from the apes' deep dives, warns that this whole infinite liquidity gambit is spiraling towards what they call an uncontrolled conclusion, one that risks total systemic failure. And so, that's where we're left. The suits are trying to navigate using maps based on old-world physics, where information moves nice and slow. But the apes, and now academia, have proven that the physics have fundamentally changed. The code can be rewritten in real time by a decentralized network of individuals. So the final question isn't if there will be another crash, but what in the world is it going to look like when it happens?
We are watching this chart like a hawk. While you wait for the next candle, grab your free gear. Sign up for Public to get $20 in free assets. Check Webull for that BTC promo, or grab your NVDS stock on Moomoo. Links are in the description. Smash the like, subscribe to the tribe. Apes together strong.